Hello and welcome guys, and welcome to this session of the Income Tax Act 1961. So yes, in this section we'll be dealing with certain basic concepts of Income Tax Act, okay? Income Tax Act 1961, which is applicable in India, which is referring to the domestic transaction which happens within India. We'll be concentrating on those transactions, and we'll be studying what kind of income taxation is required to be ascertained, what kind of taxation is required to be ascertained for the transaction which have happened in a domestic country, in domestically which are prevalent, the transaction which are happening domestically within India, those transactions, those incomes which are earned, how Government of India is charging tax on that particular income tax. But before I start this subject, guys, let me tell you one very important thing frankly, okay? As a cost accountant, Income Tax Act 1961 might not be very relevant to you. Why, sir? Because as a cost accountant, you will be required to more delve into the costing area, the cost accountancy field, the costing area of your of the business, and you will be expected to more deal with cost part of it, like raw material, like labor, like overheads, like all of the costs which are there in the business. So typically, a cost accountant might not be required to deal with income taxation in his entire life. And other professional courses like chartered accountants are specializing in income tax, and they have their core specialty in Income Tax Act 1961. So they are the people who actually do taxation for big companies. Then, sir, what is the reason that this particular subject is there in our syllabus, CMA syllabus, and we are forced to study this subject? This is such a hectic subject. It's such a pain for us. We get headaches if we even remember the provisions of this subject and try to study this subject. Why is this subject an essential element of CMA syllabus, when you are also aware that other professional bodies are governing this particular profession? This taxation profession is not relevant for CMAs. Then why is this put as a 100 marks paper in our syllabus? Guys, the reason is very simple. You just need to clear this paper as a formality's sake. So the Institute of Cost Accountants of India have introduced this particular concept as just a formality, just a part of the course content that you should study. And that is why this particular subject has been introduced in your syllabus, which is direct taxation. So no other purpose basically of the Institute of Cost Accountants of India, but just to give you a broad idea of income taxation and to assist you in qualifying your examination. We have to study this particular subject called income taxation. Guys, whatever I said in last 2-3 minutes is absolutely rubbish, is absolutely of no relevance, of no utility, and of no truth. Many students, I have seen in past, many students study income tax thinking that, sir, this is just a paper to pass. We CMAs have nothing to do with income tax, so we won't be required to practice income tax in future. So, sir, we will not be studying income tax in that in depth. We don't want in-depth knowledge of income tax. We don't want any practical knowledge of income tax. So we just have an aim that we just qualify this particular paper, just attain good marks in this particular paper, and we score well so that we clear our examination. And after that, during our professional pursuit, we will not be required to touch this subject at all. We will not be dwelling into this subject at all. We won't be touching this subject ever in our life, because we are cost accountants. We are not chartered accountants. Income tax is chartered accountants' monopoly. Many students come to me with this notion. And today, before I start domestic taxation, which is Income Tax Act 1961, before I start this important subject, let me devoid you of all the misapprehensions which you have in your mind. Guys, cost accountants are required to be well versed with income tax provisions. They need to be really confident. They really need to have in-depth knowledge of income taxation, because costing is half-cooked cake without taxation. Taxation forms a 30% of cost. Therefore, the 30% cost which is of taxation, that forms an integral element of your cost sheet. I have in my career seen many big deals of mergers and acquisition, buying, selling, repurchase of shares, etc., breaking off because of this particular concept, because of this particular deal issue, that taxation liability is too high. I have seen deals being cancelled because of this issue. So Please do not have this notion in mind. If you have this notion in mind, please throw it off before starting the Income Tax Act 1961. Because if you have this notion in mind that, sir, we are just clearing this particular subject for clearing's sake and we won't be required to use this subject ever in future, you are absolutely mistaken. This is a wrong notion which is there in your mind. Please devoid your mind from this notion. You are absolutely required to study income tax till your last breath of your professional career as a CMA. You are definitely required to do this particular subject. So yes, after highlighting the importance of this particular subject and this particular act, Income Tax Act 1961, I'm going to start the basics of Income Tax Act 1961 today. And in today's lecture, we are going to study certain basic elements like what is income, because income tax is comprised of two words, so income and taxation. What is income? What is taxation? On what subjects is income tax levied? What is person as per the act? What do you mean by year, an assessment year, a financial year? We are going to study all these things in great detail in today's lecture. We are going to start the Income Tax Act 1961 and we'll be starting with the basics of income tax. What are the terminologies being used in income tax and what are the essential elements of income tax which you should be aware of. So let's start Income Tax Act 1961. Okay, so I've written income tax, your subject, over here on the board, but as you can see, I have given a substantial space between these two words, income and tax. There is a space which is there between these two words, income and tax. There is a substantial gap which is there between these two words, income and tax. Sir, why have you written these two words with such a gap? Because, sir, whenever we hear about this word, whenever our relatives say, okay, I'm filing my income tax return, I want to know what is my income tax. I am afraid of income tax. I have to file a lot of income tax. I have to pay a lot of income tax to the government of India. Whenever we hear about all these things, then, income tax comes as a combined word in front of all of us. We think income tax as a combined word, income tax. We have never thought that these two words may be separated out. But yes, guys, before studying Income Tax Act 1961, I want to tell you that these two words are separate words. Income is a different word, tax is a different word. If I combine these two words, then you are going to focus more on tax and less on income, and I do not want that to happen. If I say income tax, then what is your focus? Tax. Income is not your focus. But I would like to tell you that your 90% focus should be income and only 10% focus should be tax. Therefore, the first principle that I'm going to teach you for the domestic laws of the country, which is Income Tax Act 1961, is income and tax are two different separate elements. Please treat both these elements separately. They are two different things. Income, take a deep breath. Tax. Income, tax. So treat these two words separately. In our course also, in our syllabus also, we will be dealing with income word for 90% of the tenure, 90% of the time, and we'll spend only 10% of the time on tax. So once you understand what do you mean by income, once you understand what is your income, once you understand what are the sources of income, what are the types of income, when is income earned, when is income received, when you understand all these stuff, only then are we going to move on to tax, which will be then minuscule, which will be then 10% of the entire syllabus. But the entire focus in our syllabus will be on income. What do you mean by income? How to calculate income? That is the main focus of our entire syllabus, sir. But why such a focus on income, sir? Sir, income is such a simple and a very plain vanilla word, sir. So income means whatever we earn. So if we earn salary, then salary is our income. If we earn rent from house property, then rent is our income. If we earn profits and gains from business and profession, that is our income. So whatever we receive is our income. But guys, income are of two types. One is real income, which you were mentioning about just now. Whatever we receive, whatever money we receive, whatever cash we receive, whatever bank and check we receive, whatever draft we receive, that is known as the real income or the monetary income or the money income. And what is taxable out of it is known as taxable income. So, Government of India has given a lot of exemptions with respect to income. So there are certain incomes which you earn, but on which Government of India do not take taxes. That is not your taxable income, that is your real income. I'll give you an example. If you are a farmer, if you are an agriculturalist, a role of agriculturalist is that he has to grow food, he has to cull out food from farms, and he has to grow food and earn for his family. That is the role of a farmer or an agriculturalist. Now, agriculturalist or a farmer earns income. Of course, that is real income, because that income is fetched and kept in pocket of the farmer. That is real income, that is money income, that is monetary income. But Government of India says that since farming is the bread and butter of majority of Indians, and since Indian economy is based on farming, and farming is a really hard work, and sometimes farmers do not even get their dues properly because of the system of middlemen which is there between farmers and the mandis. So we exempt entire income earned by the farmers. So if you are a farmer, you need not pay even a single penny of tax if you abide by certain rules and regulations. So yes, if a farmer is earning 1 lakh rupees per annum, then his real income is 1 lakh rupees. But what is his taxable income? What is his taxable income? Zero. He has no taxable income. So a farmer who earns real income as 1 lakh rupees, guys, his taxable income is zero, which means that he earns no taxable income. His taxable income is zero because as per the law, as per the Income Tax Act, the agriculture income is not taxable in India. In India, this income is absolutely exempt. So that is the difference between real income and taxable income. Real income is the income earned, the monetary value of the income which is earned. It is in terms of money, it is in terms of hard cash, it is in terms of bank. So income which is earned, that is the real income. And the income which is taxed as per the Income Tax Act, as per the Government of India, that is known as taxable income. So there's a difference between real income and taxable income. Real income is representing the purchasing power of a particular individual. Purchasing power means how much can he afford to buy. So yes, real income is the monetary income, the money income which is earned by a particular person, and it represents the purchasing power of that particular person. What purchases can he make? So if a farmer is earning 1 lakh rupees, then his purchasing power is 1 lakh rupees per annum. He can purchase goods worth rupees 1 lakh rupees. Okay, so that is the purchasing power or the money income. But what is taxable income? It is not the money income. It is the money income converted as per the law of the land into taxable income. So money income will be bifurcated into two parts. One is non-taxable income. Second is taxable income. So taxable income is that portion of money income which is taxed as per the relevant laws of India, as per the relevant laws of country. That is known as taxable income, and it derives its essence from money income. Money income is the basic thing, and whatever is derived from money income, that is known as taxable income. So taxable income is as per law. The taxable income of the country is determined as per the Income Tax Act 1961, and its base is of course the money income. So first you tell Government of India that, look, Government of India, I am a farmer. I have earned 1 lakh rupees from farming business, but I also have a side business that I retail. I am a retailer of this marker pen, and I earn 50,000 rupees by selling marker pen. Okay, so my total income, Government of India, farmer is telling Government of India, my total income is 1.5 lakhs. 1 lakhs from farming business, 50,000 from selling markers. I have two sources of income. So Government of India will tell the farmer that, look, Mr. Farmer, your 1 lakh rupees is exempt as per the Indian tax law. So that is not your taxable income, but the income which you are earning from selling the markers, that is very much taxable. So now in this case, your money income is 1,50,000. Your money income is 1,50,000 and your taxable income is 50,000. So there is a possibility that a person has two sources of income, or two places where he is earning income, and one source is exempt from tax, so one source is not taxable and other source is taxable. This is also very much possible in terms of this concept of the Income Tax Act. So yes, Income Tax Act has detailed laws, has detailed provisions on how to convert your money income into taxable income, and learning these provisions will take 90% of our time in our entire syllabus. converting the monetary income into taxable income, that will be the core of our discussion. And then finding out tax, that will be a cakewalk. Even an engineering background student can do that. Even a non-commerce graduate can do that. You just have to multiply the taxable income with the rate of tax. So suppose if rate of tax is 30%, then you have to compute the taxable income. In our case, taxable income was 50,000. 1,50,000 of the farmer, 1 lakh for farming business, 50,000 for selling marker. 50,000 was taxable income. His taxable income was 50,000. So we just have to multiply 50,000 with 30%. You will get the amount of tax, which is 15,000. So this portion, relatively simpler, less time taking, less complicated. This portion of computing income, much more time taking, much more complicated, much more lengthier. That is why we are going to spend 90% of our time in converting real income into taxable income and only 10% of our time in computing the tax amount. So that is the relevance of treating these two words separately, as income as a separate word and tax as a separate word. Income has two portions, real income versus monetary income. There are the two portions of income. Okay, sir, we got your point. Now, I have three equations written over here. Okay, I have already told you the basic concepts. Now I have three equations which are written over here. Now you have to state true or false amongst these three equations. Okay, you just have to state true or false amongst these equations. Okay, sir, let us start. Number one, can real income be greater than the taxable income? So in our case, 1,50,000 was the real income, yes, and taxable income was 50,000, yes. And if the entire 1,50,000 was earned by farming business, then entire 1,50,000 would have been not taxable. Okay, so in that case, taxable income would have been 0. So, sir, obviously, real income is more and taxable income is less. This is definitely a possibility. So, I am writing true against this equation. So, you just have to write true or false. You just have to write true or false. So can real income be higher than taxable income? Answer is yes, real income can be higher than the taxable income. Perfect, guys. Concept number 2. Can real income be equal to taxable income? Concept number 2. Can real income be equal to taxable income? Yes, sir, it can be. For example, our farmer is not doing farming business at all. He is just selling manufacturing marker pens and only selling marker pens, and his income is only derived from selling the marker pens. He is not actually earning farming income at all, so his income is not exempt. So, sir, whatever he is earning, suppose he is earning 70,000 rupees from selling marker, sir, his entire income will be taxable, 70,000. So, there is no difference between real income and taxable income. He is not doing farming. He used to do farming much before, but now he's not doing farming. Now he's only selling the marker pens. So can the real income be equal to taxable income? Of course it can be. So real income can be equal to the taxable income. And the third equation, which you have to tell whether it's true or false, whether it is possible or not. Can real income be less than taxable income? Can real income be less than taxable income? Sir, so you're trying to say that my real income is 1 lakh, so whatever I have earned in monetary terms, in cash terms, is 1 lakh. So the farmer has received 1 lakh rupees. In his pocket, he has 1 lakh rupees. He has no other business. He has no marker business, okay? Only one business, farming business. And he has received 1 lakh rupees from farming. But his taxable income is 2 lakh rupees. Is it possible? Is it possible that monetary income is less than the taxable income? The taxable income is more and monetary income is less. Is it possible? Answer is yes, it is possible. This is also true. Sir, how is it possible? It is possible, guys. I'll tell you how. The farmer who's earning 1 lakh rupees from his farmhouse, of course his entire 1 lakh rupees is free from tax, so he has nothing to pay with respect to that 1 lakh rupees. Now, Government of India comes to that particular area, and Government of India gives certain emoluments, certain perquisites to these farmers absolutely free of cost. For example, Government of India gifts a tractor worth rupees 2 lakh rupees to all the farmers of that particular area. Or why only government? Any NGO who's working for benefit of farmers, they gift the tractor worth rupees 2 lakh rupees to each farmers of that particular area to pull them out of poverty, to pull them out of the bad situation which they are in. So they have received something in kind and not in cash. Tractor worth rupees 2 lakh is received in kind to these farmers. So will that tractor which is received in kind be taxable in hands of the farmer? Answer is yes. Anything which is received in cash or in kind is taxable in hands of any assessee. So the monetary income is 1 lakh rupees. 1 lakh rupees are absolutely free of tax, so no problems in that. But the tractor worth rupees 2 lakh rupees which is received by the farmer is taxable in hands of the farmer. So the taxable income of the farmer is 2 lakh rupees. Monetary income is 1 lakh rupees. I'll give you another example, which is a more practical example and a more pragmatic, which is actually used in companies kind of an example, okay? An employee of a big multinational company has a salary package of 8 lakh rupees. An employee gets a salary package of 8 lakh rupees from very big MNC. So what is coming in hands, in pocket of that employee? The thing which is coming in pocket of that employee is 8 lakh rupees. So what is the real income of that employee? The real income of that employee is of course 8 lakh rupees. 8 lakh rupees is the real income of that particular employee. Perfect, sir. So 8 lakh rupees is the real income of that employee. Now the employer gives employee a lavish house to stay, and that lavish house costs the employer 30,000 rupees a month, which means 3,60,000 rupees of rent is paid by the employer. Employer means the company who's hiring the person, say Reliance Industries Limited. So I, Nikhil Gupta, got a job in Reliance Industries Limited. Reliance Industries Limited told me that, Nikhil Gupta, we will pay you a salary of 8 lakh rupees. I said, okay, I'm happy with salary of 8 lakh rupees. Along with salary of 8 lakh rupees, we will also bear your rental expenses of your home, which ideally you should have bear, but we'll bear it, okay? We'll bear this 30,000 rupees per month. So 3,60,000 we will additionally bear on your behalf. Income tax says that salary includes any emolument which is paid to the employee, any benefit which is paid to the employee, plus any other perquisite which is given to the employee free of cost, without charging any cost, which is benefiting the employee, that will also be added in the salary of that particular employee. Now tell me, what is the real income of the employee? 8 lakh rupees. What is the taxable income of the employee? Taxable income of the employee is 8 lakh rupees plus 3,60,000 rupees. So the taxable income is 11,60,000. The taxable income is 11,60,000. So yes, the third equation can also be true in our income tax world. Third equation can also be true, that real income is less than the taxable income. Real income is less, taxable income is more. It is very much possible in our Income Tax Act 1961 kind of a scenario. So yes, difference between taxable income and money income is very clear to you. Then the relationship between real income and taxable income should also be clear to you. So this is the relationship between real income and taxable income. Now let's come on to the tax. I've already explained you. You just need to know the rate of tax. Soon as you compute this taxable income, this is the taxable income which we have just computed. Soon as you compute this taxable income, we just have to multiply it by the rate of tax, and we are arrived at the tax amount. So tax amount will be computed soon as you multiply the taxable income with the tax rate. So now the ask is, the requirement is that you need to know how to convert the money income into taxable income, and then you need to know how taxable income is multiplied with the tax rate. What tax rate is applicable on this particular taxable income? You have to multiply it and compute the tax amount. They are the two things which we are going to study in our entire Income Tax Act syllabus. Okay, sir, we got your point. Okay, now let us move on to a concept called period. A concept called period. Okay, I'll write this concept name over here. Period. So what is meaning of period? Period means a tenure, a stipulated timeline within which a thing is to be done, a thing is to be completed. For example, time period which is given to you for completing the entire course of income tax is maybe you have given yourself 3 months. So in 3 months I will finish the entire course of direct tax. That is the period which you have given to yourself to complete a particular task, to complete a particular objective. That is the period. Okay. So now, income tax authorities are coming to you. So you have become a CMA, a qualified CMA, rank holder in inter as well as final, and you have qualified CMA with flying colors. So a company hires you at a package of 12 lakh rupees per annum. That is your starting package along with bonus and incentives separately. So that is the package which you get in a big company after qualifying a CMA. After you are CMA, you get a big package. Now when you are earning such hefty amount, when you are earning so many bucks and you are enjoying your life, you are enjoying your your family is enjoying, you are enjoying yourself to the fullest. Suddenly income tax authorities knock at your door. Hello, Mr. CMA, are you CMA? You say, yes, I'm a CMA. You even raise your collar. Yes, I'm a CMA. Mr. CMA, your salary package, please. So as a CMA, you would be proud of your salary package. And you say, yeah, I'm earning 12 lakh rupees per annum along with bonus and incentives. I earn huge bucks. I'm a big man. I'm an earning man, and I'm a very rich man. Yeah. Income tax authorities pull out their cards and say, we are from income tax. We would require you to pay income tax as per the income tax laws. Then you would say, oh shit, why did I say so much to income tax authorities? Okay, yes, I will definitely pay income tax. But the question is, when do I pay income tax? So income tax authorities tell you, you tell us when will you like to pay income tax. You pay us income tax on the income which you have earned. So we want income tax from you. So you tell them, okay, so I'm just 24 right now. 24 is my age. My age is 24. And I'm definitely going to work till the age of 60 before I retire. Okay. So listen, income tax department. You come to me when I retire. Only then will I be able to ascertain what is the accumulated income which I have earned in my entire life. And according to that, I'll be able to ascertain my tax liability, and I will pay you at the age of 60 years. Now, income tax department is saying, what if you die before 60? Who will pay income tax to us? Then you tell him, oh, no. I have shown my hand to a palmist, a very famous astrologer palmist. And he told me that you are going to be alive for 65 years. Rest assured, I'm going to be alive till 65 years. Rest assured. Don't worry about my age. My age is, I'm a long-lasting human being. My age is good enough. I'll be there for a very long period of time. So don't worry about that. You come at the age of 65, 60 years, I will pay you tax of whatever I have earned from 24 years to 60 years accumulated together. I will pay the tax together. Don't worry about that. And the Income Tax Act is actually zapped. Income Tax Act saying, what are you saying? Are you mad or what? We cannot wait for so long, and we will not wait. Why should we wait for so long? We are not waiting for so long. You pay your income taxes right now. As soon as you earn income, as soon as you receive any income, please pay us taxes. So, whatever is the date today, so today is 27th August. Suppose today is 27th August. Okay, we will come at evening, in the evening time, 8 p.m. We will come to you at 8 p.m. So whatever you have earned during the day, you please pay taxes on that particular income. We will again come on 28th August. We will come at 8 p.m. again. Whatever you have paid during the entire day, pay it to us. So guys, always understand that income tax authorities will try to prepone the payment, and you as a assessee will try to postpone the payment. Assessee will say, this is utter madness. I cannot daily, calculate my income tax and calculate the earning and give you income tax daily. No, I cannot do this. Okay, income tax department, let's settle it out. 5 years, I will pay taxes once in 5 years. So I'm 24 now. Come to me when I'm 29, and during this 5 years, whatever I've earned, I will pay you taxes for the income which is earned during the 5 years. Income tax authority says, nothing doing. We are not giving you more than 1 year's time to pay tax. So whatever you earn during 1 year, Pay your tax accumulatively. Otherwise, we will charge tax from you on a daily basis or a monthly basis or a weekly basis. So you say no, 1 year is okay. Okay. So after this intense discussion, after this intense negotiation, the appropriate time period which was ascertained for computing income and taxes was ascertained as 1 financial year. Income tax authorities will not bother you every day, will not bother you every week, will not bother you every month, will not bother you every 6 months. They will come once in a year and will charge tax from you once and for all for that particular year. This is known as tax period. Tax period. Just like you have period for your examination 6 months, June, December, June, December, June, December. You have examination period for 6 months. Income tax has a period of 1 year to levy taxation. 1 year was considered as an efficient year to levy taxation and comfortable year from an SSC standpoint as well as income tax standpoint. And of course, this was just a story which I cooked up. There was no such negotiation which happened. Law was framed without even consulting any of the people. So law was maintained and law was formed with 1 year as the relevant tax period. And this 1 year should start from 1st of April and should end on subsequent 31st of March. Should start from 1st of April and should end on subsequent 31st of March. This should be the period during which the income tax should be calculated and income tax should be paid to Government of India. So accumulatedly, we will think about our incomes, what incomes we have earned during this period. We'll think about the tax rate. We'll multiply both of them. We will convert money income into taxable income, convert both of them, and once and for all, we will pay taxes together for 1 year. Now, if I want to pay tax for 2 years together, okay, so for example, if this is 1st April 2022, this is 31st March 2023, I want to pay for next year also together, 1st April 23 and 31st March 2024, I want to pay taxes for 2 years together. I don't want to enter into hassle of computing tax for 1 year and then going to other. I will pay taxes for 2 years together. Not possible. Not possible. Income tax have defined the financial year as 1 year period, 12 months period starting from 1st April to 31st March of the subsequent year. And this is known as a financial year. This is known as the concept of financial year. Now this concept is prevalent in India. Guys, let me tell you, this concept can be very different in United States of America, can be different in Singapore, can be different in Thailand, can be different in any other part of the world. So for example, in USA, this financial year period can range from 1st of January to 31st of December. Generally, it is for 12 months, but the starting and end date is different. So we have a starting date as 1st of April to 31st of March. USA might have starting date of 1st of January till 31st of December. Some people have starting day of 1st of September till next 31st of August. So period might change from country to country. But in India, the financial year which is followed is 1st of April to 31st of March. So I'll give you an example of the two parts of financial year. So I've told you what is financial year. Now we are coming on to the two parts of financial year. So this is the financial year. Financial year has two parts, previous year and assessment year. Now please understand the difference between previous year and assessment year. Okay. So I'm talking about the period. So I became a CMA in the year 1st April 2022 to 31st March 23. So this is the year in which I became a CMA and I started my job. Okay. So on 1st April 2022, I started doing job in a very big company as a CMA and I started earning income. And I earned income till 31st March 2023. Now, as soon as I got a job on 1st April 2022, income tax authorities called me up. They said that, okay, you are a CMA, you've got a job also. Please pay us taxes. So what will I tell them? I'll tell them, wait. Let this entire year get over. When this entire year gets over, then I'm going to pay you your due taxes, not before that. As per the Income Tax Act, as per the law, I'm going to pay you once and for all for the entire year. Income Tax Act says, okay, you are right. So we'll wait for some time. You say, yes, you will have to wait for some time. As soon as 31st March 2023 strikes, as soon as the year end, income tax officials are at your home. You're not even woken up in the morning. You are having your bed tea, or you are having some rasam with aplam, and you're just having your morning rituals, and you are having some puja, you are having some god worship and some mantrocharan, etc. And suddenly you get a knock at your home. Hey, open your door, Mr. CMA, open your door. And you say, who's this? He says, this is income tax department. You committed to us that on 31st March 2023, that is the closing date of the financial year, you are going to pay us taxes. You are going to tell us what tax you have to pay, and you have to pay us taxes. Please pay your taxes. As soon as the income tax department asks you for paying taxes, you tell them, dear income tax department, tell me something. Is 31st March 2023 over, or will it get over at 12 midnight? Income tax authority says, of course it will get over by 12 midnight. So you ask them, is there a probability that till 12 midnight on 31st March I will receive some income? Yes, there's a possibility till 12 midnight you can earn some income, some lottery, you can win some lottery, you can win anything. Salary is fixed, but other income can be earned by you. Yes. So if I can earn income till 12 midnight, then I cannot estimate my tax and income till 12 midnight. So it's better you come tomorrow, 1st April 2023, not right now. You come tomorrow on 1st April 2023 and you take me details of my income on 1st April 2023. Don't take these details now. That will make more sense. It will be more logical. Now income tax department is saying, yes, that makes more sense. That is more logical to come back on 1st April 2023 rather than hitting the people right now. But soon as 1st April 2023 comes and the clock strikes 12 midnight, which financial year have we entered into? So this financial year was financial year 22-23, which we were talking about. But soon as the clock strikes 12 on 31st March 2023, which financial year is triggered? Which financial year is started? Financial year 23-24 has started. So the income which belongs to financial year 22-23, it is taxed or it is assessed in the financial year 23-24, because it is not possible to earn income and even estimate that income beforehand we cannot estimate that income. So we need some time, and that time is taken, and that time is taken for the assessment year. So there are 2 years. Previous year, financial year in which income is earned is known as the previous year, and the assessment year, which is the immediately subsequent financial year. That is the assessment year. It says financial year in which tax is ascertained for the previous year. So for previous year 22-23, what is the assessment year? Assessment year is 23-24. So if I ask you, which year's income are you assessing or are you taxing in assessment year 23-24, then you will say, I am taxing income of 22-23 in 23-24. So the year in which income is earned, that is known as the previous year. Income in which that income is taxed is known as the assessment year. Now I'll have one more question for you. Of course, you will be earning income during the year 23-24. You will be earning income during this year as well. So now for income which is earned in this year, in which financial year will you tax it? Immediately subsequent financial year, which is 24-25. So for previous year 23-24, which is the assessment year? Assessment year is 24-25. So assessment year is the immediately succeeding year. Previous year is the immediately preceding year. That is the relationship between previous year and assessment year. So you always earn income during a previous year, and you always pay taxes on that income during the assessment year. That is the relationship between previous year and assessment year. So let's read once more. Previous year means financial year in which income is earned. That is known as the previous year. Then what is the assessment year? Assessment year means the financial year in which the tax is ascertained for the previous year. The financial year in which tax is ascertained is known as the assessment year. The word itself suggests assess. Assess means to compute. Assess means to compute. So in the assessment year, we compute the tax with respect to the previous year's income. So this is the relationship between previous year and assessment year. They are both correlated with each other. They are both intermingled. They are both connected with each other. So previous year means an year in which income is earned, and for that year, the income will be assessed in the assessment year, which will be the subsequent year. Because the income cannot be assessed in the same year because of obvious reasons, because of reasons that in the same year you cannot estimate the income with great accuracy, because till 12 midnight you can earn income, and after 12 midnight new financial year starts. So that is the difference between financial year, two types of financial years. Previous year is a financial year in which income is earned. Assessment year is the financial year in which income is ascertained or assessed. Then we come on to the last basic concept of our first chapter of basics, subject matter of income tax. So who all can be subjected to income tax? Can you be subjected to income tax? Yes, you can be subject to income tax when you will start earning income. Can I be subjected to income tax? Yes, I will also be subjected to income tax because of the income which I earn, my teaching income. So who can be subject matter of tax, that we are going to study now, and the subject can be classified into two parts. One is a person and second is an assessee. So now we are going to discuss about an assessee and a person. The subject matter of Income Tax Act. Income tax can be levied on certain set of class of people. Who are those people and what are the conditions required to levy income tax on those people? So we are going to discuss two definitions, definition of a person and definition of an assessee. Now, what is definition of a person? A person is an individual. Now, this is not a definition actually. This is types of persons. Who are the types of persons? They can be artificial persons, they can be natural persons. So what is artificial person? What is natural person? Natural person means human beings like me, like you. Artificial person means non-human beings like a company, like a partnership firm, like a cooperative society. All these are artificial people. So according to Income Tax Act, there can be artificial persons and non-artificial persons. Both persons are possible, and the list which is given in the Income Tax Act is an exhaustive list. No one else have to really fall in the category of person apart from these people. So what is the definition of person as per the Income Tax Act? A person can be an individual. It can be an HUF. What is full form of HUF? Hindu Undivided Family. Now what do you mean by individual? Individual means me, you, natural person, whose identity, whose biological existence is there, and biologically who's a living being. He's alive. So I am alive. You are alive. You are an individual. I am an individual. What is a Hindu Undivided Family? Hindu Undivided Family is a partnership firm or a joint venture or a partnership which is categorized by certain specific rules which have been in the Indian society since time immemorial. So since a very long time, we have been following a close connection of Hindu Undivided Families, HUFs, which are working in the sphere of manufacturing and trading and all the business activities since a very long time. So instead of classifying them or asking them to classify themselves as a company or as a partnership firm or as a joint venture, something like that, we have given them a different identity. Their identity is known as HUF, Hindu Undivided Family. And yes, Jainism, Jains, Sikhs are also a part of HUF society. So HUF means a group of, an agglomeration of, a conglomeration of Hindus who are belonging to the same family, who are connected through their blood relation with each other. And of course, the wives of the male member of the families are also a part of HUF. So HUF means Hindu Undivided Family, families which have been working together as a Hindu Undivided Family. They are known as Hindu Undivided Family, which has been recognized by the Income Tax Act as a person. So Hindu Undivided Family is a person. Then a company of course should be registered under the Companies Act 2013, and any kind of company, public company, private company, government company, non-government company, any kind of company which is existing as per the Indian laws, that is recognized as a company. Then a firm. Firm means a partnership firm or an LLP. Partnership firm, which means two or more unrelated people come together as a joint venture and they start working on a project, on a assignment, or on a profit earning business. That is known as a partnership firm. And LLP means limited liability partnership. So the normal partnership firm is categorized by having unlimited liability for all its members. However, LLP is categorized as having limited liability of the members. Only one member has unlimited liability, who is the main member of that LLP, who is known as a designated partner. DP, designated partner. Only one member has a unlimited liability. Rest all the members have limited liability. This is the characteristic of LLP, limited liability partnership. Then we have AOP or BOI. AOP means association of persons. BOI means body of individuals. Now, let me start by explaining you what is body of individuals. Body of individual means a situation where two or more individuals come together to perform a task or to perform an activity. Sir, but isn't it similar to the firm, to the partnership firm? No, guys, it is not similar to the partnership firm, because in partnership firm there is a deed, there is a agreement, oral or written agreement, that we are going to enter into partnership and we are going to do this particular job. However, in case of BOI, body of individuals, there are many people who come together to perform a particular task, and they might not have any relationship with each other. They might not have any agreement with each other. In partnership firm, all the partners have agreement with each other. They have agreed on certain set terms and conditions. However, in case of BOI, body of individuals, two individuals are not connected with each other. So I'll give you an example. During Durga Puja, which is one of the biggest festivals of East India, during Durga Puja, many people individually come together to assemble the pandals and to assemble the Durga Puja committee members are there, and those committee members come together to perform this humongous task of constructing those pandals and giving them the final touches and all. So all those people are accumulated, or they assimilate on the basis of a religious connect, okay? On the basis of religious emotion, because of which they are connected. They are voluntarily connected, first of all. They are not involuntarily connected. Voluntarily they are connected, and they contribute some money, or they don't contribute some money. They get some donations and they perform Durga Puja rituals. They construct pandals. They construct all the necessary things which are required surrounding the pandal. They do all that stuff, and that particular group of people is known as body of individuals. They are not partnership firm because they don't have an agreement with each other. They do not have any set terms and conditions with each other. So that is not known as a partnership firm, but they are known as body of individuals. Individuals who have come together to perform a particular task. Now, what is AOP? Association of person. Similarly, like body of individuals is association of individuals, AOP is association of persons. Now, any of these persons can come together to perform some task. So suppose a company, HUF and individual, all three come together to perform a task, but they don't have to, they don't want to enter into any partnership agreement or something like that. They, all three of them, have come together to perform a particular task. That is known as AOP, association of persons. BOI is body of individuals. Individuals mean there can be only individuals in that particular association. However, in case of association of persons, there can be individuals, there can be partnership firms, there can be HUF, there can be any other form of persons. So AOP and BOI similar in construct, but different in their people who are assimilating together, people who are putting their hands together. Next, local authority. Local authority means any authority which is responsible for giving a safe and clean environment. So for example, in Delhi there is something called NDMC, New Delhi Municipal Corporation. That is a local body which is established under the realms of Delhi government. Similarly, Bombay, we have Bombay Municipal Corporation, BMC. Similarly, in South India we could have Chennai Municipal Corporation, CMC. So any local body which is working at a local level, at a government, at a state government level, and has an independent entity apart from state government, but it is funded by state government, it is regulated by state government, but it has an independent entity, it is a local authority, that is known as local authority, and if it earns money, then definitely it is categorized under the definition of person. Then we have artificial juridical person. Now this is a very important category, guys. Sometimes apart from these categories, there can be something which is artificial, which is earning money. I'll give you an example. You know, if you go in a temple, then you have an idol of God. So if you go to Jagannath Puri, you have idol of Lord Krishna with his sister and brother. So Jagannath Puri is a temple. Again, the main source of income of that temple is the contribution or the donation which is received on that idol. So that idol is actually the income generating person. That idol which is there in the temple is the income generated person. So artificial juridical person means any artificial entity or any artificial body or any artificial thing which is actually generating money, that is known as artificial juridical person. And idols, God's idols, are included in artificial juridical person. So yes, we will not leave even God from perspective of income tax if God is earning any money. Of course, the temple's incomes are clubbed under charitable organization, charitable institute. So that is a different theory of studying altogether. And we'll be having charitable organizations, taxation regime separately in one of our chapters. We'll be discussing it in great detail. Now this is the definition of persons. So we have so many persons in our periphery, in our Income Tax Act. So my question is, are you a person? Answer is yes. Am I a person? Answer is yes. Is this remote control a person? Yes, this remote control is a person, categorized under artificial juridical person. Is this camera which is kept in front of me, is this a person? Yes, this is a person. Is the laptop which is in front of me, is it a person? Yes, it is a person, artificial juridical person. Is Mr. Joseph of USA a person? Yes, Mr. Joseph of USA is a person. Whether he is in India or outside India, he is a person. So the definition of person is very broad, very large. I'm not saying that every person needs to pay tax in India. I'm not saying that. I've just now culled out the definition of person. Now we will be seeing the definition of assessee, and then we'll be correlating between the two. So who's an assessee? Any person. So first of all, you need to be a person to be an assessee. Okay. So any person who comes under the purview of Income Tax Act in any specified manner. So who's an assessee? Assessee is a person who comes under perspective of Income Tax Act under any prescribed manner. And how can you come under perspective of Income Tax Act? Of course, by earning money, by earning revenue. If you earn revenue, you become an assessee. If you become taxable, if your income is taxable, as we have studied over there, if your income is taxable, you become an assessee. So now my question to you, are you a person? Answer is yes. You said a yes. Am I a person? You said a yes. Now my second question is, please listen to my second question properly. Am I an assessee? Am I an assessee? Answer is yes, because I am earning income and I have to pay tax on that income. So I am an assessee. Now my other question is, are you an assessee? Are you an assessee? Answer is no. You are not earning income as of now. You are a student. You have no source of income. You are relying on your parents' income. You are relying on your parents' contribution for your income. So you are not an income. You are not an income generator. So you are not an assessee. I am an assessee because I am generating income. But are you a person? Yes, you are a person. Person is a broad definition. Everyone gets covered under person. So you are a person. But are you an assessee? Answer is no. You are not an assessee because you are not earning any income. Since you are not earning any income, you are not liable to tax. Since you are not liable to tax, you are not an assessee. So those persons who are earning any income, they become assessee. They become assessee. So any such person who is earning an income, he becomes an assessee. And there are certain other criteria also to become an assessee. This is one of the major criteria, earning income. There are a few more criteria which we are going to study in our book. But the broad one is, the major one is, if a person starts earning income, he becomes an assessee. Once he becomes an assessee, he comes under the purview of the Income Tax Act. Now I'll ask you a question. Is Mr. Joseph, who is residing in United States of America, a person? Answer is yes, he's a person. But is he an assessee? Now you need to ask me, sir, is he earning any income in India? If my answer is yes, then you will say yes, he becomes an assessee. But if I say no, he's not, he's got no connect with India, he's never come to India, he's not earned any money from India, there is no connection with him and India, never ever has he earned any money in India, then what you will say? You will say that, sir, then no, he is not an assessee. So to be an assessee or to not be an assessee, there has to be a person who has earned some income which is taxable in India, or he is liable to pay taxes in any other manner in India, then he becomes an assessee. So person plus taxability plus his taxability is equal to assessee. Assessee means a person who is taxable in India, who earns income in India, is known as an assessee. This is the difference between a person and an assessee. Alright, so this is a broad overview of your basic concepts. The difference between income and tax, that is first and very important thing. Then the difference between previous year and assessment year, next difference. Then person and assessee, this is the third difference which is to be appreciated, which is to be understood by you. Now let us move on to our book and let's see what are the essential elements of these three things in a theoretical manner in the book, whatever theory we have in our book. Let's see, and let us see how do we define all these things in a proper manner, how does section define all these things, and then let's do some practical questions of these parts.